Hey everyone, welcome back to The Explainer. So today we are getting cozy with a highly requested, visually structured study session designed specifically for my diploma students tackling FAR210. We are going to completely demystify MFRS 116. Specifically, we're looking at the sometimes tricky world of property, plant, and equipment, and exactly how we measure it after we buy it. I want you to picture this session like a beautifully organized, pastel-colored set of digital flashcards. I'm going to guide you through these concepts step by step, taking it from the basics all the way to the advanced stuff. By the end of this explainer, you are going to be totally ready to ace your final exams. So grab your favorite highlighters and let's get started. Here is our friendly study planner for today. We'll be covering the two paths, the cost model, the yearly versus monthly trap, the revaluation model, the post-revaluation boss battle, and we'll wrap it all up with some exam tips and a summary. Let's jump right in. All right, section 1, the two paths. Picture this. You've just started up a cute little bakery, and you bought a brand new delivery van. Fantastic, right? You've recorded that initial purchase in your accounts. But here is the inciting incident. As time passes, that van is getting older. It's putting on miles. So how do we measure its value year after year? Well, the MFRS 116 standard doesn't actually force you into one strict box. It gives entities a choice. After initial recognition, you literally choose your accounting policy path. You can either take the safe, highly reliable route known as the cost model, or you can take the dynamic route, updating to current market values, which is known as the revaluation model. It's kind of like a choose-your-own accounting adventure book. Moving on to section 2, the cost model. When you choose that cost model path, your main challenge, your daily quest, if you will, is mastering the depreciation calculation. We are basically just slowly expensing the cost of that bakery van over its useful life. Now, I know calculations can sometimes feel like a lot. So to prevent any cognitive overload, we are going to break down the straight-line depreciation method into 3 super digestible steps. Think of it just like a recipe. Step 1, calculate the initial cost. Step 2, determine the depreciable amount. And step 3, calculate the actual depreciation charge for the year. Simple, right? Let's look at a real business scenario straight from your lecture notes to see this in action. Let's look at this working example for VW BHD. They just bought a motor vehicle. For step 1, the purchase price was $180,000. But wait, they got a rebate. The absolute crucial point here is that we must deduct that $2,000 rebate. You don't pay for it, you don't record it. Then we add the necessary costs to actually get the van on the road, things like registration fees of $300 and insurance of $1,200. That brings our true total initial cost to $179,500. Then, for step 2, our depreciable amount is just that initial cost minus the residual value. Since the residual value is 0 here, our base for depreciation remains $179,500. And this brilliantly illustrates exactly what happens over the next 3 years. Because we're using straight-line depreciation over 5 years, we just divide that RM $179,500 by 5. That gives us a yearly charge of RM $35,900. Look at the schedule. Notice how the depreciation column stays exactly the same every single year. But watch the accumulated depreciation. It grows. It goes from $35,900 up to $71,800 and then up to $107,700. Meanwhile, the net carrying amount, which is the true value left on your books, shrinks year by year. It's literally like a seesaw. One goes up, the other goes down. Section 3, the yearly versus monthly trap. Okay, I'm stepping in right now as your friendly guide to give you a massive warning. This is the single most common trap you will face in your FAR 210 exams regarding depreciation timing. Students lose easy marks here all the time. Here is a side-by-side comparison of the two policies. When an exam question says yearly basis, you charge a full year of depreciation no matter what month the asset was bought, even if you bought it on New Year's Eve in December. But if the question explicitly says monthly basis, you must prorate the depreciation based on the exact month it was purchased. You really have to count those months out carefully on your fingers if you need to. Let me read this crucial quote directly from your lecture notes, just to emphatically stamp this rule right into your memory. Quote, yearly basis. For the year ended 31 December 20x6, the depreciation was charged for a 1-year period, even though the machine was bought on 6 June 20x6. Did you catch that? They bought it in June, right smack in the middle of the year. But because the accounting policy is yearly basis, bam, a full year's depreciation is charged. Always, always underline the policy wording in your exam paper. Next up, section 4, the revaluation model. Let's shift gears to that second path. Sometimes things don't just lose value. Imagine the land your bakery sits on suddenly becomes the hottest new spot in town. It's worth way more than what you paid for it. Under the revaluation model, your asset gets a fresh, shiny new fair value to reflect that reality. When we revalue land and create a surplus, that revaluation surplus is recorded as other comprehensive income in the statement of profit or loss and other comprehensive income. It does not go to your regular day-to-day profit. Instead, it gets safely credited to your equity section, tucked neatly into the asset revaluation reserve account. It's kind of like putting your property's value increase into a special, highly secure savings jar.
Section 5. The Post-Revaluation Boss Battle.
All right, brace yourselves. This is the trickiest part of MFRS 116. Calculating the new depreciation after an asset has been revalued requires a strategic accounting combo move. First part of the combo, before we can even look at the new value, we must clear out the old baggage. Take example 9 here. The asset originally cost RM $900,000, and over 7 years, it gathered RM $126,000 in accumulated depreciation. The absolute crucial step here is eliminating that prior accumulated depreciation. We deduct it to find the true carrying amount, which leaves us with RM $774,000. Only then can we compare that RM $774,000 to the new fair value of $1,200,000 to find our glorious surplus of RM $426,000.
Okay, so we have our shiny new fair value of $1,200,000. Now we need to figure out how to depreciate it going forward. This illustrates the ultimate boss rule formula for your exam. Depreciation equals fair value divided by the remaining useful life. Notice that key word. We must divide the new $1,200,000 value by the remaining 43 years, not the original 50 years. Let's define this explicitly, because forgetting to subtract the past years is the #1 mistake students make. Remaining useful life means the original useful life of the asset minus the years that have already passed prior to the revaluation. In our previous example, the original life was 50 years. We had already owned it and depreciated it for 7 years before we decided to revalue it. So 50 minus 7 leaves us with 43 years. You absolutely must use the 43.
Finally, Section 6, Exam Tips and Summary. We've defeated the boss. Let's bring this cozy study session to a close with a tidy checklist you can mentally tick off during your test. Number 1, when reading the question, first identify the model. Are we doing cost or revaluation? Number 2, read the dates and policies incredibly carefully. Is it a yearly basis or a monthly basis? Number 3, remember your accounting treatment. Revaluation surplus goes to other comprehensive income and equity. And finally, the boss rule. After a revaluation, always calculate depreciation using the remaining useful life. Take a deep breath in and exhale. You have done a fantastic job walking through these complex accounting treatments today. You are now fully equipped with the knowledge, the formulas, and the awareness of those common traps to absolutely ace MFRS 116. But before we go, I want you to think about this. If a company can literally choose between the cost model and the revaluation model, how might their choice completely change the story their balance sheet tells to potential investors? Keep this explainer handy for your revision. And until next time, stay curious and keep learning.